Good evening, ladies and gentlemen. Welcome to this special edition of Market Masters, where you get to meet the finest brains on the Lal Street. Our guest today is a specialist fund manager, Mr. Mihir Vora. He's the Chief Investment Officer at the recently launched Trust Mutual Fund, and they have now come up with their first portfolio of the Flexi Cap portfolio product that they had recently launched. Mihir has been in capital markets since 1994. He's worked variously with SBI Mutual Fund, Prudential, ICICI, ABN AMRO, HSBC, with Birla Sun Life as well, and is now at the helm of affairs at Trust Mutual Fund. With me is also Sakshi, my colleague. Mihir, a very warm welcome to you, and what a pleasure to host you at a time when Indian markets have created world records in terms of consistently rising 14 days in a row, and I believe everybody in the fraternity is either happy or very happy. How is your mood?
Hi Shailendra, hello Sakshi, thank you for having me on the show. As we were just discussing, nobody's complaining. There is no need to complain, and I think it's only a testament to our resilience as an economy that the markets are doing what they are. In fact, as we know, the US markets, the global markets have been so volatile in the last 1 month, especially with the currency movements in the yen, etc. That if you look at the overnight markets, you would have thought that Indian markets are going to open like 2% down or 1% down. But we've been quite rational. Of course, we have moved in tandem with the markets, but nowhere as close to the violent moves that we saw in the other markets, which inherently means that the Indian economy, the visibility is far more and far stable compared to the rest of the world, which is I think our core strength, and that's reflecting not only in the equity markets but also in the bond markets and the currency markets. So our bond markets have been remarkably stable. Our currency has been remarkably stable against most of the global currencies, which basically means that our visibility of growth and the India story is far more stable and predictable compared to the rest of the world.
Right. Mr. Vora, another thing that I wanted to ask you is that there is this underlying fear that, probably this is the time that we should be pulling out our money, profitability, wherever we are at, and sit up on some cash. Is that some of the narrative that you're also hearing around? And is there merit in that argument?
See, I don't think there is anything to tell us that you should change your strategic asset allocation. I mean, yes, the markets have done very well and stocks have gone up. But if you look at the earnings growth over the last 4 5 years, that's also been quite robust. So if you look at most of the major indices, whether it's the large cap indices or even the mid and small cap indices, the rise in the index is actually mimicking the rise in earnings so far. So as far as aggregate valuations are concerned, I would say they are a little above average, but not in a bubble zone or anything to be panicky about. Yes, of course, there are certain stocks and pockets where probably there is excess froth and speculation, but that does not mean the whole market is expensive. And as I said, there is no reason to change the strategic asset allocation. Having said that, with the kind of dream run that we have had, not only this year, but this probably will be our 9th year of gains if we end this calendar year. It's a record, right? Like you said, 14 days of continuous rise was a record. So even this year, if we end up as a positive year, which it looks like, then that also will be another record as far as the Indian markets are concerned, the winning streak is concerned. So having done so well, there is always reason to be, I would say choosy, but not necessarily cautious. That's what I say.
All right. Mihir, records are meant to be broken, and bigger and better ones that should be set so that future generations also have something to look forward to in terms of creating their own records. So I'm very hopeful that 9th straight year of gains is what we are looking forward to, and of course with the adequate caution and some corrections, we'll continue to steam ahead. We are now meeting you ahead of the US Federal Reserve's all-important meeting on 17th and 18th, where a view will be taken on the cut on interest rates. It's almost a given that 25 basis points is with us, 50 if we are really lucky. How do you see that changing the dynamics of the Indian capital markets? A couple of sectors which you think might be big beneficiaries of this impending rate cut and possibly coming to our shows as well.
Sure. So I don't think there is a very tight correlation between US rate cuts and its impact on the Indian markets. But having said that, if there is a US rate cut, and as you said, it's a given more or less in September, whether it's 25 or 50 is a matter of debate. But there will be a positive impact on global flows. I'm quite convinced because once you have the US starting the rate cut cycle, which means that financial conditions are easing, and the peak of the tightening that we saw is past us. So that will have a good beneficial impact on flows to other markets apart from the US. So far, what's happened in the last 1 year is that the dollar has been so resilient and so strong that most of the flows have been attracted to the dollar assets, including the US markets, bond as well as equities. Because if you're getting 4% on a dollar asset, then there is no reason for you to invest elsewhere because then the risk premium, etc., doesn't justify it. But once the US yields start coming, then people will be more open to other asset classes, including emerging market bonds and equities, which is where we should start to benefit. What will also happen is that after the US Fed rate cuts, we will also have the inflation differential between India and the US, which is at a certain level, and the interest rate differential between India and US, that will start to increase. That means that there will be scope for the RBI also to start cutting after, say, 3 or 6 months. So that again can have a good salutary impact. Typically, what we have seen is that rate cuts are positive for the markets depending on the stage of the life cycle of the economy. Right now, we are at a stage where even the US economy is in kind of a question mark zone where there are some good data points, but some incrementally not so great data points. And in such a scenario, when the US starts cutting, it means that the Fed is trying to preempt a slowdown, which is a good thing. Then at least we won't have a sharp downturn as some sections of the market fear.
Okay, Mr. Vora, we do have some questions that are pouring in from our viewers, and one of those questions I wanted to take with you. Ranjana Kala from New Delhi has written, could you please recommend any sectors that are less affected by global events over the medium term in the markets? So in case we are looking at these situations that you were talking about, US Fed will be in action in just a few days, and then there will be the US elections in November. Investors are already getting worried as to how do they hedge their portfolios, which could be probably impacted by any global events or volatility right there. How would you advise?
Sure. So not only because of the US Fed cuts, but in general, for the last quite a few years, we've been of the view that the Indian markets and the Indian economy will definitely be better off compared to the rest of the world, including the US. And that's, I think, already panning out as we discussed. Our markets have been far less volatile and far more stable, both for equities as well as for the currencies and even for the fixed income market. So I think that thesis, if we were to extrapolate in the future, that Indian growth compared to the rest of the world will continue to be, far better. We are more positive on the domestic-looking sectors. That means, the biggest, enabler of Indian growth will be the financials, banks, NBFCs, capital markets. So all the financials, including insurance, asset management, wealth management, all that bunch of, lenders as well as non-lenders should actually be good drivers for the Indian economy. So that's one big chunk of the market that one should be positive on. Second, of course, is consumption, which has been a bedrock of the Indian economy, discretionary as well as non-discretionary, FMCG. But I would more prefer the discretionary part because I think the growth rates will be higher. So consumer discretionary, and of course the big piece on investments theme, which is basically your real estate, capital goods, investments, and manufacturing linked themes. I think those should do better. On the flip side, we would be underweight on IT. We would be underweight on, say, sectors like metals, energy, which are more linked to global prices. Pharmaceuticals is a sector which is quite stable and that benefits both from the Indian economy as well as the global because that has nothing to do with business cycles per se. And India's core strengths in pharmaceuticals are well known. and the world is looking to diversify away from China. So that's another sector which for us is a bit global looking, I would say, but that should continue to do well on a consistent basis. So these are some of the themes that I would play given the global uncertainty.
Okay, ladies and gentlemen, now that the macro picture is clear in front of us, I'd like you to all tighten your seat belts. We are now going to discuss one of the best known schemes on the flexi cap space, which is Trust Mutual Fund flexi cap scheme. It was launched on April of 26, 2024, and you would just want to hold your breath when you listen to the returns. In the past 4 months, the fund itself has appreciated 17.6%. That is a sterling performance from Mihir. Congratulations once again, Mihir bhai. What a wonderful show at a time when you have faced probably some of the wildest volatile events, which is the national election, the yen carry trade unwinding, mediocre first quarter, a run on Bangladesh. Sakshi, I have forgotten the kind of problems that we faced in the past 4 months, such as the regularity of. Yes, of course. So, Mihir, over to you. What were the broad goalposts that you set yourself when you started managing this corpus, which is at about 620 crores as of now?
Sure. Thank you, Shailendra, for the kind words. And as we speak, the corpus has crossed 710 crores, so we're getting decent inflows. See, I think what we did was when we started the NFO, which was our first fund, we had only our philosophy to talk about. What we did was exactly implement the philosophy that we talked about in terms of growth at reasonable valuations and terminal value investing. So what we had said is that by nature, we are growth investors. We would like to see growth, earnings growth in a stock, and then consider valuations. And by valuations, we also mean the long-term growth prospects, not only the next 2 to 3 years. And we built a portfolio of about 50 to 60 stocks, and we've been running a tight portfolio of about 50 to 60 stocks. And exactly the things that we mentioned, that we like, basically financialization of savings, premium consumption, physical asset creation, and new business models, especially the new age companies. So those, I think, 60 stocks portfolio, reasonably focused, has done well for us. And essentially, we stick to our knitting and basically be growth investors at reasonable valuations. And that's what we'll try to follow on a faithful basis.
Okay, you'll see the top holdings coming in form of graphics. Let's not spend time on them. Mihir, I just want to understand that in the last 1 month or so, we have seen the old world smokestack sectors push Nifty to a record high. Very strong move on technology, fabulous move on pharma, and of course a more than decent move on FMCG as well. How have they been represented in your purchases over the last 3 odd months? When you see this rally in pharma, is it something to be worried about? Should chips be taken away from the table? And how do you see it moving forward?
Sure. So 2 or 3 questions or points you raised, so try to address all of them. So when you say last couple of months, what we have done is while we continue to be bullish on the domestic theme of physical asset creation, which means capital goods, construction, infrastructure, defense, railways, all those themes. What we also saw was that there was a bit of a frenzy in these segments, and probably some of the stocks, as you said, we launched the fund just 4.5 months ago, and we bought all these themes in the initial portfolio. But some of the stocks gave returns in the next couple of months, which we thought we would get in the next 2 years. So in those cases, we actually didn't mind booking profits where we thought there was a temporary overshoot vis-a-vis the fundamentals. So while we continue to remain very bullish on these things for the next 5 years or so, probably in the short term they had overshot. So in the last 1 month, we actually reduced quite a bit of exposure to these segments. What we've also done is we've increased exposure to some of the stocks where we thought that there is now relative better valuation given the growth adjusted equation that we are looking at. So there, some of the pharma names fit in very well. Some of the IT names which had underperformed quite a lot, they fit in very well. And some of the stocks in the discretionary theme also fit in very well. And now we do believe that there is a little bit of case for consumption to come back in the limelight, because as we see the monsoon panning out, seems to be fine. And we also have a little bit of populism in the state government budget. So if you notice over the last few months, many states have announced large schemes, large welfare schemes, or what you can see, freebie schemes, which should now start supporting rural consumption also, which was a weak point. So we've shifted the portfolio a bit in that direction.
Okay, Mr. Vora, how has your thought process been with respect to the new age internet space so far, and have things improvised there? Are you including more to the list that you may already have been tracking? And what is your sense on the newer IPOs that are coming in? Today we've seen Premier Energies again shoot up 20% up right after days after getting listed. Ola Electric is seeming to be getting back on track again with a 5-6% move today. How are you looking at the entire new age internet plus the new IPOs?
So in the new age space, we are quite positive. As I said, it was one of the four pillars that we mentioned during our NFO also, and we have exposure to these segments. Our base thesis is that these business models are very prone to network effects, and once companies gain a certain critical size, it's very difficult to displace them or even replicate them. So to that extent, after a certain point, it becomes a two-player or three-player market with good profitability, given the network effect that happens. So I think these business models are here to stay. They are disruptive business models, but given the size of the Indian consumer market and the number of customers that these companies have managed to enroll, and the sheer size of the what you can call the TAM, the target addressable market, these companies still have a long runway of growth. So because they can not only grow the customer base organically, but most of the companies also start then going into adjacencies of consumer markets. So you can have different the same infrastructure with a fresh set of customers or fresh market coming in. So I think the runway of growth, which is the core of our terminal value investing, is very large in some of these new age companies, and we are very actively, we have active exposure to the portfolio, but we also are looking at new business models continuously. As far as the IPO market is concerned, we evaluate IPOs like any other stock, whether it's listed or unlisted. We would like to buy IPOs at a little bit of discount compared to secondary market or listed market valuations comparables, because obviously you need to make a little bit of money while you invest in an IPO. Otherwise, there is no difference in the way we evaluate an IPO versus a normal stock.
Let's sort of try and understand your thought process on the defense sector, Mihir Bhai. I see just one stock in defense in the 60 that you hold, and that's Hindustan Aeronautics. Absolutely, how should I say, a minuscule exposure to defense. Is this correction that we see during August something that you are looking forward to for adding these counters? I'm sure the tailwind is something that you really like, but perhaps it's the growth at adequate price which is still not working for Trust Mutual Fund as far as defense space is concerned. What are your thoughts here?
Sure. So as I mentioned, we are very positive in the medium term to long term in this space, not only defense but the general capital spending and infrastructure space, including manufacturing linked segments. We are very positive, and there is no doubt that we have a long runway of growth. But as I also mentioned, there are certain stocks where we thought that the price movements had probably overshot. So actually, we had a very large exposure to defense in the first 3 months of the portfolio. But as I said, some of the stocks just ran up too much. So we had about 4 or 5 names in the defense space, and we are down to 2 now, having booked profits in some of those. But this is a segment where we definitely want to be in the long term. So as and when there's a price correction or a time correction, we would certainly like to be there.
Okay, Mr. Vora, is there anything which is standing out for you as a red flag or a risk in the current market setup? And in case yes, then what would that be? What should investors be careful of as we move forward from here within the markets?
Sure. Couple of not red flags, I would say, but things to monitor. One is there is very good signs. There are very good signs that the U.S. economy is slowing down. So if you look at the job openings number, if you look at some of the credit card delinquencies, existing home sales, new home sales number, things are turning down, right? So that's one overhang that we need to keep a tab on, because that will import exports, and that will impact exports and of course the global economy. So that's one thing that certainly we are looking at. Second thing that I observed is that the first quarter earnings, the June quarter earnings, were not that great for India. So if you look at the top 1,500 stocks, the overall earnings growth was like low single digit after a long time. So the benefit that we had over the previous few quarters was that of margin expansion, which is now no longer there because it's come normalized. So now we need the top line to grow, because you're not going to have the benefit of margin expansion. There, the call is that the consumption theme will now carry on the rest of the year, and then in the next couple of quarters after the in the festive season and after the monsoon, we should see a beginning of the consumption pickup. So that's one thing to look out for. That consumption needs to pick up now because it's been a drag for so long. Private sector investments, is the jury is still out. There is green shoots, and hopefully these green shoots should accelerate, because very simply put, without private sector capex and private sector investments, both in housing and infrastructure and manufacturing capacities, I don't think we are in a position to grow at the 7%. Without private sector investments picking up, including real estate and housing, I think we can grow at maybe 5 to 6%. That extra 1% has to come from investments linked. So that is something that we need to keep a close watch on. What we have also seen as I would say again, a watch point is that in the last few months, we've seen state governments rolling out freebies and cutting on capital expenditure. So in the first 4 months of the year, the state governments have probably rolled out freebies of 60, 70, 80,000 crores, all states put together. And the capex in the first 4 months is down by 20,000 crores at the state level. So that we need to see whether that slowdown in capex was just because of election linked activities. Typically, there is a pause during the election times. Hopefully, in the second half, it should pick up. So that's something that I would also keep a close eye on.
That's a very interesting thought, something that we will monitor over the next 12 months or so. Mihir bhai, when I look at your portfolio, the first three top picks are banks, HDFC Bank, ICICI and SBI. As also amongst the top 12, I think 8 are blue chips, all a part of the Nifty. Given the theme that runs at your background at Trust Mutual Fund, which is growth at a sensible price and a lot of, how should I say, predictability in terms of revenue and profit streams, are private sector banks the perfect vehicle for you for a nice compounding from current levels?
So within financials, I would like to break it up into three components. One is banks, second one is NBFCs, and third is the other part of the financial services, which is the non-lenders. So banks and NBFCs are the lenders, and then we have the non-lenders. Within non-lenders, there are of course sub-segments. You have insurance, you have wealth management, you have broking, you have capital markets, you have the stock exchanges, and the mutual fund distributors. So there's a long bunch of sub-components in the non-lenders. I would say that given that we are in a situation where rate cuts are going to start kicking in the next few months, not only for India, but for the rest of the world. Within the lenders, which is the banks and NBFCs, I would say that the NBFCs probably will get the first benefit. Because what we have seen is that the bank's lending book is typically floating rate to a great extent, whereas for the NBFCs, a lot of the book is fixed rate. So when you have rate cuts coming in, immediately the impact is on the borrowing cost, which is the deposit cost or the short-term borrowing. And there the NBFCs benefit because the lending book will continue to be at a fixed rate, a lot of it, and the deposit cost will start kicking in and go lower. So in the initial first few quarters, probably you might see the NBFCs to be in a better space. Banks will of course catch up in due course, but the first benefit will be to the NBFCs. So if you see, we are actually underweight on banks, both PSU and private sector banks, and overweight on some of the lending, the NBFC names. So that's on the lenders. Within the non-lenders, actually, we are quite positive. We are positive across the segment, whether it's insurance, whether it's wealth management, whether it's mutual fund distributors, capital markets, exchanges, brokers. We are quite bullish on all the segments because that's perfectly in sync with the theme that we are looking at, which is financialization of savings and premium consumption.
Okay. Mr. Vora, another thing is that how are you looking at the broader markets, the mid and the small caps? Why I'm asking this is that after some bit of consolidation, some action is coming back again. When the space started to consolidate a bit and correct a bit was actually after a whole host of narrative was being built that this space has become very frothy, valuations are overheated, one should be very, very careful. SEBI had asked even AMFI to regulate some of the funds that were flowing in to the broader markets. How would you look at these two spaces now, and what would you advise an average retail investor out there?
See, my view is that the small cap space is very large. Even if you take a cutoff of 2,000 crores market cap, there are still probably 800 stocks to choose from in the small cap space. So the choice is very large, and actually, if you want exposure to certain high growth segments, and the ones that we discussed, I would say the opportunities are predominantly in the mid and small cap space, especially the small cap space. So if you want exposure to the fastest growing segments in the economy, you probably have no choice but to look in the small and mid cap space. So I think I would say that there is wide choice available, and sometimes in certain segments you have no choice but to go for the mid and small cap space. So I think, as we said, it's time to be choosy, if not cautious, but that's perfectly fine, because then we can dig deeper and find those pockets of value, because the canvas is quite large.
Mihir, a couple of questions on where you've trimmed exposure. Defense is something that you've mentioned that out of 5, now only 1 is left in the portfolio. In terms of sectoral approach, now what looks frothy and what is something that you are avoiding?
So overall sector, I would not say the whole sector looks frothy, but I would say large caps, especially the top 100 stocks, if you look at the aggregate valuations, they actually come down to quite reasonable valuations. So that's one segment I'm comfortable with. I would be very worried about stocks where the free float is very less, and the volumes are unusually high. So that's a lot of the low free float segments, both in the private sector space as well as the public sector space, where the promoter holding is so high that the free float is probably 5, 10, 15, 20%. And that's where you see huge volumes, which means that it's basically the domain of retail speculators, not institutions. So those kind of pockets I would avoid. And second is, I would avoid companies where there has been consistently negative cash flows or unexplained capital expenditures, etc., or unusual capital expenditures, because that's to me a red flag. So some of the unknown names or less known names where there is no analyst coverage, in the small cap space, micro cap space, those are the names where I would really dig deeper and take a good sound check of the promoter background, etc., before going into.
Okay, do you think, Mr. Vora, the time has come to be a little bit more defensive rather than, go after the, sectors that were so far in the limelight? Should one just increase their positions or hedge their portfolios with a lot of FMCG, IT and pharma names right now? Would that be the right strategy?
No, I would not say that, because within pharma also there are high growth stocks. Within FMCG also there are some mid and small caps. We are growing much faster than the industry. In fact, there are some stocks growing at 15-20% also within FMCG. So I think India is such a vast market that there is always choices even within sectors at all points in time. So I think, as I said, it's time to be choosy if not cautious, but there is enough choice available there.
Okay, ladies and gentlemen, so that was a very nice rundown on what the market is at the moment, what to avoid and where to step in, and of course a very, very detailed in-depth review of Trust Mutual Fund Flexi Cap scheme. Please keep this fund on your radar over the next 5-10 years or so. I'll be watching out its performance along with Sakshi, and I'm sure Mr. Vora will do a great job at creating long-term wealth in the least possible time for his unit holders. Mihir, before we let you go, it's the 9th straight year of potential gains. We'd just like to know your value of the Nifty, which you think it will be on December 31st.
I'll be happy if we stay at these levels, because even if the Nifty stays stable, there is enough number of stocks which will go up in the meantime. So I think a disciplined, slow rise in the Nifty is all that we need. We don't need the Nifty to go up every day.
Okay, wonderful.
So you will be happy with where we are. That's 17% appreciation year to date, and let's hope we round it off to 25%. With that, Mihir bhai, thank you so much for your time, and here's wishing you all the best for future endeavors, and of course nipping that growth at the right price for you. Thank you so much.
Thank you, Shail.
Thank you.
Thank you, Sakshi.
Thank you.
That, ladies and gentlemen, was Mr. Mihir Vora. He's the Chief Investment Officer at Trust Mutual Funds, whose maiden NFO, Trust Flexi Cap Fund, we discussed. The fund is up 17.6% over the past 4 months, and this is one of those schemes that should be a part of your long-term portfolio. Thank you for watching us. I hope you enjoyed this conversation as much as Sakshi and I did. And please continue watching Business Today television. There's a lot happening on the other side of this break. Thank you.
I have with me the most awaited SUV of 2024 for the past 4 years actually, the new Mahindra Thar Rocks. What's different? What's the tech check like? Most importantly, you must have seen a bunch of reviews and the first drives, but what's it like in Mumbai's monsoons? Is it the ideal family city SUV? All that and more in this special segment of Tech Today.